Okay, good morning, everybody. Thank you for taking time to learn with us today. The topic is long-term care, what advisors need to know. We have a lot of information, so I'm going to get right into the uh, dialogue here. So we'll continue to provide resources to you so you can have better client conversations when discussing long-term care. We'll discuss our client EDU portal and give you that link and send a few resources at the end of the program or in the next couple of days. It's very clear we're on the protection side of protection versus probabilities, but what side are you on and what side are each of your clients on is the question at hand. A simple reality in life is you will either live, die, or become disabled. There's a lot of risks we face in retirement, and I suggest that we consider adjusting our overall risk management conversations and have them together versus discussing each risk separately along the way. We'll discuss more. There are an array of products available to insure for long-term care protection. We'll give you insight on how they work and where they best fit. And in addition to helping you educate you, the advisor, we created a client EDU portal. Again, we'll share that address later and send a link to it. But these are things we just overhauled our stuff, and it'll help leverage your time and educate your clients or your underlings, quite frankly. And then sometimes mainstream long-term care products won't work or are not available, and we'll share some alternatives when we have unhealthy situations. So probably the most well-known statistic or well-stated statistic is that when you reach age 65, you have a 70% shot of needing care within the rest of your life. But when we break it down versus this pie chart here, we really have a 50-50 shot, a 50% shot that you'll either not need care or not need it more than a year. We don't worry about the small things, but it's the other half of the chart that's a problem, especially greater than 5 years. Couple other stats here. We know that on average, women need care for 3.7 years and men need care for 2.2 years. Now, keep that in mind that that's the average. When you're dealing with wealthier clients, they tend to live a little bit longer, and as they do, they'll have more deterioration, maybe a larger chance of needing care. But the one we all find scary are the words dementia and Alzheimer's. They can strike fear in anybody's heart. And the reality is the statistics are scary. It's a very emotional subject and hard to watch it happen to our loved ones. And that 4 to 8 year average care is the scary part here for us to consider. And we just know that in the next 30 years, we're going to almost triple the amount of people getting care for these conditions. Some claim stats, just to put a little more scare to things here, and this is from one of our long-term care carriers. You can see that there have been claims well in excess of 15 years or longer. And I want to mention here, unfortunately, I experienced Alzheimer's with my dad. He passed away in 2023, but my dad received informal care for 7 years before we needed more help than just the family could provide. And I'm not really sure that some of that informal care is hitting the radar. So these stats might even be longer than we would like to think. And like most things these days, the cost of care continues to rise and likely above the average inflation rate because we continue to have a shortage of caregivers, quite frankly. And the subject is a societal problem, and needing care will wipe out some and substantially negatively affect others, is the reality. What I find funny about people is they'll buy a lottery ticket where they have one in a gazillion chance of winning, but they'll really think they're going to win. But when I present them statistics that you might have a 50-50 shot of needing some substantial care, they like to point the finger instead of looking at the mirror. But note that our home care, at times, we're only showing a 4 hour day period in our grid here, but if you need 24/7 care at home, it can be even more expensive than the nursing home. And asset size matters here, but certainly if you needed 5 years of care, 20 years down the road, $1 million dent to your wealth can hurt a lot of people. So if you hang out with me for any period of time, you know I'm a big music fan. I'm always quoting lyrics to people. And I pulled this one out from Todd Snyder. I certainly recommend checking out his stuff, but he has a song titled Statistician Blues. And in it, he sings 65% of the statistics are made up on the spot, and 82.4% believe them, whether they're accurate statistics or not. But it's his refrain that I think is a good way to think about long-term care. It's too much to think about, too much to figure out. You're stuck between hope and doubt. And so again, it gets back to what you believe, and are you a probability or protection planner? And even if you're the other side, what's your client? So what we want to help our clients do is have a plan. If they need care, we have two very important questions we need to answer with them. Who's going to care for you, and how will you pay? There's many people that rely on family. In fact, I often get what I consider a smokescreen objection in talking about long-term care with certain people is they'll say, it's okay, the kids are going to take care of us. And of course, my next question is, have you told them? And when you're dealing with your younger clients, you might find a way to segue to a referral to their parents by asking, do they know what their parents' long-term care plan is? Do they know it's not them? Isn't it good to have a conversation? Because reality is, family might work for some, but others won't have that opportunity for many reasons. Maybe the kids don't live near them, or there'd be such a disruption because either you have to move in with mom, or mom moves in with you. And so some people are going to have limited means and no insurance, and family and friends or government may be the only options. And those without financial means might end up being one of those Medicaid spend down situations. So make no mistake about it, unpaid caregiving is not free. There is a cost. My dad passed away in 2023, and he had been cared for at 7 years, as I had mentioned. And the part that I want to discuss is the psychological damage. I'm forever grateful that my niece's husband is a nurse, and he was the one coming over to bathe my dad. It saved me from carrying those memories. But near his end, I'm not quite sure I'm going to get those sounds of his struggling to breathe out of my head. So we find people with insurance get care sooner, which alleviates the asset and mental strain. And on our portal and as part of our kit, we'll share a caregiver guide that has a lot of resources available in it as well. So if the government is going to pay, it's in two limited situations. And a lot of people misunderstand this and think that they're covered under Medicare. But the reality is Medicare only pays up to 100 days and only after a certain hospitalization. And then they stop paying with rare exception. There started to be some home care things that they're helping, but just very infrequently. And Medicaid only pays after you've spent down most of your assets. And anybody who's dealt with the Medicaid stuff, your quality of care will be diminished. And I'm not sure of the state laws in your state, but in Illinois, where I live, if you're single, you can't have more than 2 grand. And if you're married, they'll let you keep 109 in assets, your house and your car. So again, most people that we work with have some means, and they don't ever intend to be a Medicaid spend down, but who knows? So whose money are you going to use? If you're not relying on your family or the government, it's up to you or insurance, or perhaps a combination of both. And so many people believe that high net worth clients don't need long-term care because they're wealthy. But we regularly place coverage on these individuals and consider it best to have the long-term care conversation with all of your clients. Of course, somebody with $1 million in assets, we could question if they have enough. Somebody with 10 million, hey, we know they have enough, right? But the reality is you have to access money when you need it. And there's shrinkage. If the money's in a large IRA, you're going to have to pull tax out on the way for every dollar that you take out for care. If you're in the market and the market's down, you won't have a choice. You can't wait for a rebound. You have to liquidate those assets for it. And some might use a reverse mortgage, which has a validity to it. But one thing that's important for those self-funders is to understand if they have any legacy or charitable goals. And the reason being is if they don't have a significant amount of assets and they do need significant care, then it could disrupt the legacy or charitable planning. So those are things you might want to take care of. Gift your life insurance policy out of your estate so that it's irrevocably somewhere else, either owned by the kids or an irrevocable trust, so that it accomplishes the inheritance if that's what you want to do. And I want to share a story that hit us a long time ago because I think it resonates here about how we falsely think we shouldn't discuss long-term care with our high net worth clients, and that's a blank check story. And so, long story short, I was brought into a situation by an advisor. The client had a significant net worth. He was very intelligent, actually retired from a major 8 accounting firm. And he had his significant net worth was already after he gave away his exclusions and lifetime exemptions and all that. And along the way, he asked us about long-term care. And he ended up buying a very significant policy that was a 10-pay with lifetime benefits and a high monthly amount. And when we asked him, we need your help here, Mike. You're wealthy, and we're trained kind of as advisors to not be talking about long-term care with the wealthy, but yet you know what you're doing and you bought this and can you share your perspective? And he just answered with, he goes, well, look, I don't know if I'm going to need care. I don't know if my wife's going to need care. And if we need care, I don't know how long we're going to need it or what that's going to cost. And that to me sounds like I'm writing a blank check. And I'm not in the habit of writing blank checks. And he understood, again, he gave away all of his lifetime and so forth. So everything he was going to die with was going to be taxable. And he knew that giving away those premiums, the kids were only going to get half of it anyway. And the leverage into the benefits was significant. And again, he chose to buy a Lexus kind of policy, if you will, and a lesson for us to learn perhaps. And so do we transfer the risk when we have risks that are too big to retain, like our auto and homeowners and so forth? We have to insure. And so this helps us preserve and leverage our assets, create tax-free benefits, and get the quality care when we need. And we're going to take a look at the 3 different options for care, for long-term care insurance options for traditional, hybrids, and life or annuity with rider. But the reality in life is you're going to either live, die, or become disabled. The longer you live, you aspire to have a pile of money or a stream of income to live off of. And today, some people, the ROI that they care about is the reliability of their income. And so we can help with lifetime annuities. If you die, of course, life insurance can be of value. And another story that came up recently, I watch a number of different sources, and this one place, advisors opine and others give their reaction to it and so forth. And there was a story on there about a lady whose husband died, and he needed some care before he died, and that drained some of their assets because he didn't have long-term care, and he had a pension, but she was only going to get half of it. He chose that option instead of 100%. And then there was Social Security loss. So the advisor had a lot of concern of her livelihood and stuff. And I just asked one question to the reply chain, and I said, well, I wonder how things would be different if she had life insurance. So long-term care is not guaranteed, but death is. And thus, having life insurance with a rider might be a good solution for many. If they don't need care, it can replace those lost incomes or allow you to annuitize other assets and not disinherit, or it can be your legacy or whatever. There's all kinds of ways it can help. So the economic outlook has changed. And so people you might have had a conversation with 5 years ago, you might want to go back and discuss it again. You see, what I continue to see is that we're having risk management conversations in a silo. Longevity risk. Well, do you or don't you need an annuity? Long-term care. Do you or don't you need long-term care insurance? Market risk. Should I be in safe things to protect my principal or the market? We can never eliminate sequence of return risk, and then the cost of liquidity means monetizing your assets. Don't confuse the size of the pile with the access to the pile. And so I find that a lot of people are having investment and not protection conversations with their client. They're projection planning versus protection planning. And again, your situation, your client's situation, but perhaps the question needs to change to which risks will you insure and which risks will you retain? So you can do cash flow analysis for long-term care, of course, but you have to make sure that you're using accurate projections and what's the tax going to be if you have to pull the money out of your IRA and so forth. What if the market goes down substantial right before you need care? These are all things that matter. I look at my job as placing safety nets under people. I'm in the liquidity, leverage, and tax free game, if you will. And so when we design products, I prefer guarantees, but there's projection products in my world just the same. And when you really are relying on things, I think guarantees matter. And what matters to you and I might be different than what matters to your client if you only ask them. At the end of the day, in addition to installing safety nets, I provide peace of mind for those on the fence, not knowing if they do have enough or not. Under certain circumstances, we might, under others, we might not. Insurance can add peace of mind and be that safety net. And so when I look back, are we doing, with hindsight, did we do harm or not by having insurance or not having insurance? But generally speaking, if you have some long-term care insurance in the mix, it'll add flexibility and increase your positive outcome. And I had a situation that I'll share again. This was a unique one that we had a wealthy client that I was working with for a certain business arrangement. And along the way, he had asked me about long-term care insurance. And again, because I'm a partner with advisors and I was there doing my job and not stepping out of line, I had to go back to my advisor and say, hey, the client's asking about long-term care. And the reason he was asking is he had an uncle that needed a lot of care and he saw the devastation to the estate. And at that time, the advisor said, well, don't worry about it. I'll talk to him. And I never heard anything again about it. And obviously, we didn't put any long-term care on him. And then 5 years later, he had early onset dementia. He ended up dying not long ago, and he needed about 8 or 9 years of care. And so the good thing is he had the wealth to pay for all that. He was getting 24/7 at home. And the bad thing is that could have been our money in there had only we put that insurance there. And so we just never know. So long-term care insurance is about asset protection, asset leverage, and dignity. Instead of exposing too many of your assets, why not take some and leverage to protect the rest of the pile is the thinking. And if anything, by having some insurance, you buy time to adjust the plan. For those that didn't have a significant wealth and might be doing a Medicaid spend down, maybe you have 5 years of protection that allows you to start getting some assets out of the estate and not violate the 5-year rule that we have. And so the reality is, if I knew which one of your clients was going to need care, we would only insure them, but it doesn't work that way. And thus, I aspire to put safety nets under most. And as far as the statistics go, when you are one, it doesn't matter what the statistics are. If you're faced with a long-term care event and you didn't get insurance, it's a little too late. And so creating tax-free cash when needed and avoiding the shrinkage of other assets makes sense to a lot of people. And so let's get into the different options here. So funding options available for long-term care. There's a little grid from our friends at Lincoln, and you can see that self-funding, there's no leverage, and then there's annuities with riders and life insurance with riders and hybrids that are the combination products, and then traditional long-term care. Generally speaking, for our premium dollar, it provides the biggest bucket of protection. But that's changing a little bit these days. Now, you're going to see that I back off that red line at the top about hybrid solutions. I've distinguished that third category of life insurance with a rider in its own category, and I'm going to show you why. So where the world thinks that anything with any kind of rider is a hybrid, I disagree, and we'll show you the three options here. So traditional long-term care, I call it pure protection. I'm not trying to accumulate any money. I want to spend the least amount each year. And I know that I can analogize these products to auto and homeowners insurance, right? You pay, and unless you have a claim, you don't get anything back. And just like auto and homeowners, most traditional plans could have price increase exposure through the years, and most of our horror stories happening today are from that happening with certain carriers. So in our example, as we move forward in the orange lettering in the little left corner, I just want to emphasize that we can either, to fairly compare, we either have to match benefits or match premium. And so we're matching premium here. We have a female, a single female, age 60, and we're spending $10,000 a year for 10 years. So this is a unique traditional product that does allow a 10 pay or a 1 pay for that matter, but it's a way for us to fairly compare the benefits then, right, and compare and contrast. And so if she buys this, she'd have an immediate bucket of protection of $241. She'd be able to access $3,300 a month this year. And by age 80, she'll have $6,000 a month and a $435,000 bucket. Now, a couple of things on this. One, these numbers are linear. So if 10,000 for 10 years is not what your client wants to do or can do, then you can cut it in half and the benefits will be half. And likewise, if you want more benefits and you double it, the benefits are double. So a lot of people look at protecting their pile, and so what they look for from insurance is enough benefit along with any income coming in to pay for care so that they don't need to touch the pile. And so why expose the pile when you have things like a hybrid policy? Why not take some of the money from the pile and leverage it into a care bucket? In this case, and we'll see a comparative of the three side by side in a few minutes, but in this case, this is a superior contract to what we just looked at because it's higher benefits, and we add the benefit of being able to quit and get your money back. But I was showing a guaranteed pricing traditional on the previous screen. This is guaranteed pricing, but this has a benefit, the death benefit on this. So if the client goes in their sleep, as we all aspire to, it still pays out $101,000. You'll see that in a few minutes. But this is how a hybrid works. A bucket with ability to access so much per year that grows over time. And I just want to pause for a second. If you came in late, we need you to log 50 minutes. We keep track of that stuff here in the system. And at the end of the program, a survey will pop up in your browser. We appreciate you filling in the full survey, but please at least fill in your CFP code or let us know if you're not one, so we can not delay by recording the CE credits to CFP organization. So this is life with rider, and I like to call this a known outcome. And the reason why this differs, and I don't call it a hybrid, is because the death benefit is your pool of care. When we look back at the hybrid here, we have a much bigger pool of care than what the death benefit is. The death benefit's 101 on this. You'll see that in a couple of minutes. So the beauty of life with rider is if you don't need care, it's going to pay out at death, or whatever you don't use for care will pay out at death. But one way or the other, you're paying for a known outcome, the 267 death benefit here. And I'm kind of a bottom line guy. I don't know when people are going to die, but if you're looking at this and want to compare it to out investing insurance, by age 80, if this lady were to die then, you would have to net 6.05% in your investment alternative. That's net of management fee or any taxation along the way. And like most life products in this arena that are guaranteed, in older ages, it turns out to be a bond alternative yield, net of everything. So at age 90, if she dies, we're getting just under 4% on our IRR. Again, that's a net number because it's an income tax-free death benefit or income tax-free long-term care for the right products. And then one last thing for this one is that if this lady were preferred, we'd buy more death benefit, of course. Okay, so one other housekeeping, if you do have questions, you do have a chat box or questions box in your bar, add them in there. We'll get to as many as we can at the end, or I'll personally answer your question after the program if I can't get to it today. Now, what we know about long-term care is a lot of people wait too long to buy it, and then it's more costly, or even worse, their health doesn't allow them to get it. And so these are just some stats we have about traditional long-term care applications at a certain carrier as to what percentage of policies are declined for people. And so if we know this, if we know this is coming, if we know that we might be looking at long-term care, well, why don't we think about it earlier is the thing. So this is a comparison. What if this lady didn't wait till age 60 to buy her care and spend the $10,000 for 10 years? What if she bought at age 40 a permanent life insurance policy with a long-term care rider, chronic illness rider? She would be able to buy almost a $500,000 bucket for $4,000 a year to age 65. So what I wanted to use here is it's the same $100,000 outlay, but I have a significantly better bucket of protection. And imagine again, back to that widowhood penalty story that I shared a few minutes ago. If she and her husband had one of these and they add flexibility and more safety for when the first person dies, for any loss of income from Social Security, pensions, things like that. They guarantee, maybe they transfer the policy as legacy, but you can see that it adds flexibility and enhances a positive outcome as the end of the day. And so I attended the NAPFA conference last year in Nashville, and I sat in on a long-term care presentation being done by another advisor, and somebody in the audience asked an interesting question, and I really wanted to tell them about what I'm about to tell you, but it wasn't appropriate and not my space and so forth. And so there are things that you can do today to protect your client and their ability to get a long-term care option later in life. So we're locking in their good health today, and we're creating a what if, we're creating a safety valve in case what if becomes what now. So this is the fact that some term policies today have inclusive riders, some have additional riders that allow you to convert later and have a permanent product with a chronic rider to it. And so I just have on the board the price had this lady bought a 30-year term at age 30, a 30-year $1 million term with the special rider on it, show you the cost of it. So this is a little bit higher than what the cheaper terms would be, but it's protecting more than the others. And It's not likely, but lightning can strike any of us, right? I'm never naive to that. I have stories. I'm a long time in the insurance business and I've seen it. And so it's the difference of having a car crash and instead of being waist down paralyzed, you're neck down paralyzed. Now, not only do you hope that your paycheck is protected from disability insurance, but what's going to pay for your care? If she had this, she could instantly make it accessible 90 days later and start collecting dollar for dollar off the death benefit. So this is a way for kids, grandkids, and younger adults that you deal with to protect their future and have the option to have a long-term care solution later in life when they're ready to commit to it. And you know, the car accident is a unique and a rare situation. What's more likely to happen here is a health condition comes up. Maybe she develops MS through the years. And I know one thing, at age 60, she's not going to buy a long-term care product of any substance if she has an MS diagnosis in most situations. So you see, the life insurance conversation is different than any other insurance conversation we have on our clients. Most people are thinking term these days and short these days, and they don't fully consider the value of owning some life insurance until the day that you die. When you add a long-term care rider to it, it only makes that protection vehicle more flexible and allows different outcomes down the road that you wouldn't have available if you didn't have it. And as I showed, in the long run, permanent insurance, if somebody lives to advanced ages, is equivalent to a bond yield. And so it wasn't throwing money out the window. In fact, you might look at it as a bond part of a portfolio when you're using certain contracts out there. And this product that I speak of, it's kind of a call option to get long-term care insurance. I'm locking in good health today, and I can adjust tomorrow as I need, whether I have that incident when what if turns into what now, or if my health deteriorates. And again, if I want to use hindsight, if I'm totally healthy when I'm age 60 and I'm ready to buy long-term care, well, then I overpaid on my term insurance policy a little bit, but I don't know any better way or other way to protect in this. And I want to, out of the three categories of traditional, hybrids, and life with rider, there's more confusion, more options in the life with rider category. And I just want to emphasize that some policies have inbred riders that are going to discount what you get. They also add the benefit of having critical illness coverage in some policies versus chronic. But the policy that I spoke of a minute ago only has a chronic available rider and guarantee to get it later, irrespective of your health. And so for those that are going to need care someday, if you own an insurance product for long-term care, there's really only two important questions of your product. How much are you going to give me? How long are you going to give it to me for? And so I like to play the claims game because I see a lot of advisors and or clients have analysis paralysis trying to pick the right one. And the reality is we won't know until we know down the road. But when you look at this grid, these are the numbers out of those examples we gave. And again, note the traditional versus the hybrid, that the hybrid's clearly better, but these hybrids have streamlined underwriting and they kind of, most of them are pass or fail. So if you don't pass, you fail. And so sometimes I can't get you the hybrid, so I might get you the traditional. But if this lady were perfectly healthy, it's a no-brainer that the hybrid's a better buy for her dollar because it's better benefits, including a death benefit if she goes in her sleep, and including the ability to quit and get some of her money back or all of it, depending on the design of the product. So, and then life with rider, note that as far as the first question, how much you're going to give me, it wins all the way up to age 90. 10,000 a month is better than 33 or 4,200. But let's play the claims game. So if this lady died in 10 years, never needing care, which option do we want? Well, that's easy. I want the 267 death benefit paid back to my family. What if she dies at age 80 and needs 1 year of care? Answer's the same. Out of the 267, roughly 120 something is paid for care, and the balance will be paid when she dies. But if she has dementia at age 90, which one does she want? Clear winner again, the hybrid. 10,000 a month and almost 800,000 to last a long time for me. So only hindsight's 2020. And what I want to infer as well for people is I see people having conversations with their client and they end up kicking the can down the road. But the reality of this subject is to get long-term care, or any of my insurances for that matter, you need not only money, but good health. And so it's logical, take some money, leverage it in tax-free dollars. And again, emphasizing that if you decide not to buy long-term care, which is your right, right? We're doing we as planners, we're doing our job by discussing this with clients. We can lead them to the water, they can drink it or not. And you certainly want to document and record those conversations to cover your butt, if you will. But if they have legacy goals, you might want to discuss that along the way. And this is dependent on what their asset level is, right? If they want to leave something and they have less assets, they might want to get that out of their estate so that it doesn't get spent down later if that's where they end up. And maybe they're going to remain self-insured after looking at everything. But hopefully you're not stereotyping. Hopefully you're not giving the same answer to every single client, because some clients may value long-term care more than others. Single people who don't have kids, I don't have anybody to care for me, so I'm going to have to use a caregiver. And depending on my assets, again, maybe I want to have extra protection so I know that I'm okay during the rest of my life, because family wouldn't be an option in that example. And if you have less assets, this is a subjective thing here, right? What level do you consider? I roughly, if somebody's a 600,000 net worth or below, I don't often find those people working with fee-only planners, to be clear. You usually have a better net worth and higher incomes and all that, but they probably can't afford, or you might say don't have enough to protect. People between 600 and maybe up to a couple of million is probably the sweet spot. And then again, a lot of people, the larger your net worth, the more they think you wouldn't have the conversation or buy insurance. But I assure you, I have stories. Again, we've placed a lot of long-term care on people with wealth just the same. And so are you doing protection or probability thinking? I'm the safety net guy, so you don't fall too far. That's my thinking. I'm biased in that way, but my job is to help your clients decide if this is right for them or not. And if they choose not to, then we did our job. Next person, and we'll still be fine. So educate and document your discussions. And I want to spend our last 10 minutes here. Again, if you have any questions, put them in the questions box. If you came in late, please stay on during the Q&A. We need you to log 50 minutes to get your hour of CE. So we're going to look at these four options: pay your spouse or child, a shared bucket, and a high deductible umbrella-like plan, and then a legacy or care option. And so here, if you want to pay informal caregivers, your spouse, your child, and a less skilled person that lives with you, you need an indemnity claims model. Now, to my knowledge, there is no longer any traditional long-term care plans available for indemnity claims, but there are hybrids and there's lots of life with rider solutions. So again, begin with the end in mind, as Stephen Covey tells us. If I want to control my care regimen, I might want an indemnity product. Now, some clients don't have the 10,000 a year for 10 years for both spouses. So we do the best we can with our means. When I have limited resources in a family, most of the time, all things equal, I'll spend that money on the female versus the male, because 70% of the occupants of nursing homes are females. And that's playing the odds, if you will, right? But if I want coverage on both people, maybe I use a product that insures both. And there's a few hybrids out there that have a shared bucket of care. And we're showing you the numbers on one with just one $10,000 for 10-year premium in it. Now, throughout time, I've been asked, a few advisors, gee, I wish there was something like a umbrella liability policy for long-term care where I can risk my own assets up to a certain point and then I get theirs. And that product exists right now today. This is an example of it. We give a $200,000 single premium in my design here. So we're not 10 a year for each spouse for 10 years, we're 200 lump sum. This product is a second to die death benefit. So if neither of them ever need any care, the 244 pays out. If they need a little bit of care, the balance of 244 will pay out at the second death. But what this does is it uses your money first. So your 244,000 death benefit is the first part of the care they'll do. And that's your money, if you will, right? Leverage a few dollars. And after that, you have 10,000 a month for each person for the rest of their lives as needed. So for those people who want to have a high deductible umbrella type of long-term care, that does exist today with a certain product. And then this last one, this is, I name it Legacy or Care, and this is only for couples here. This happens to be a second to die policy as well. But notice this, versus the yield and the IRRs that we saw on the single female at 60 years old purchasing it. When she was age 90 a few pages ago, we showed a 4% or a little bit under 4% net yield. This is a 7% if the second person lives to age 90. And the reason being is this doesn't pay for both people. The first person who needs care isn't insured for care. They're not drawn off the death benefit. But once the first person passes, or if both people need care at the same time, then the monthly amount is accessible. And again, whatever is not spent for care will be left to the family for legacy. And so we literally just a client, he's one of these borderline, not sure I have enough. I don't know if I was unlucky enough for me and my wife to both have an unfavorable length of care and costly and so forth, it could really dent, and I want to leave the kids more and so forth. So he's purchasing this product for a $500,000 bucket and understands the value and the virtues of it. So this is another option for people to consider before they think about saying no to all other options. So now what if people aren't healthy? Well, we could use qualified longevity annuity contracts. We could use a deferred annuity that doubles the income when I need care. We could use a deferred annuity that doubles the bucket of care. We could use life insurance. And this is something when I find people that are uninsurable, I have one right now that I'm working on. They didn't really understand why I was asking if they have any life insurance policies. But some people have a term policy that's convertible, and you use this as a replenish the bucket. In other words, I get sick, I drain down some of the bucket of care because I don't have long-term care, waited too long, couldn't buy it, unhealthy, can't get other insurances that of value. Maybe I have my life insurance to replenish the bucket for my spouse if that were to happen. That's a potential here. And then again, if you're unhealthy and legacy is important to you, then it's even more important to maybe give away those assets or put them in the irrevocable trust so that they don't come down with you if you need a lot of care. I'm breathing now. A lot of material. We expanded a little bit here, but I think we added some pertinent things for you, and appreciate your feedback on the survey when you return it. And so you might be familiar with the long-term care payroll tax in Washington. A lot of stuff has happened the last few years, and we've kind of states have put this on the back burner and such, but it's kind of a ridiculous plan because they're taking 58 cents for every $100 of earning out of your payroll now to provide a whopping $36,000 of lifetime long-term care benefits. And to make it even worse, you have to satisfy, I don't even know what the 10 ADLs are. We're so used to saying 2 of 6. So I couldn't regurgitate the other 4 that they list here, but they require 3 ADLs to even get these benefits as well. So I think they just found another way to tax people. You can be the judge on that. But what we know, what I've been looking at is California and New York, because they seem to be next up on what they're doing. Other states, and we're sending an article in our kit on this with you too. So, but other states looking at this are Connecticut, Hawaii, Kentucky, Maine, Maryland, Minnesota, and Pennsylvania. And who knows? But what sneaky things New York is doing is that first of all, they're not allowing anything but traditional long-term care. So Washington allowed anything that was 7702 registered, and that's true hybrid and qualified long-term care riders, not chronic riders on life insurance and stuff. You had to have the good stuff, if you will, the verifiable stuff, in order to exempt yourself from that payroll tax. But New York, if they first of all, they anything when they make it a law, it retroacts to January 1st of that year. So if they pass it in September, unless you had coverage prior to January of that year, you're in trouble. And so you might not have time to react or do anything. I know there was an overwhelmness in the insurance industry to process all the apps of the people that were buying them to be exempt from that payroll tax. So again, your younger, higher income earners are the one to discuss the most with this, because they'll be most burdened by that payroll tax. So with that, we hope to provide and inspire quality long-term care conversations with your client. Evaluate whether insurance should be considered as a funding option to protect their assets. Consider which risks they should insure. We look at longevity and other things that could be a concern instead of siloing each risk. Utilize our resources to plan and educate, document their desires and decision. Utilize IAC for screening health, designing plans, and implementing protection as needed. And so again, I'll get to your questions in a couple of minutes here, but this here, if you want to take, I'll keep this real quick here, but we're sending this out in the next couple of days when we send our kit. But this is our client EDU portal. Your clients only find it because you share it with them. I only work through advisors, or I might occasionally get a referral from a client we've helped. But when people reach out to me that are not advisors, my first question is, what advisor sent you here? And with that, you'll find our long-term care planning discussion guide, our Exploring the Options article and video, cost of care calculators, the caregiver guide, a lot of resources on there to help you educate your clients, or perhaps your counterparts that are newer in the business and trying to digest this. So in that, this is our discussion guide. We think that we've made something here that you could just take this and have a strong conversation with your client. And if you want to explore the options, likewise, we went through the 3 flavors, traditional, hybrids, and life with rider, pure protection, payback and protection, or know an outcome, as I like to call the 3 options. We have some design questions in there as well to be able to ask your clients. So this is my contact info, and I'm going to start answering questions in a minute, but I just want to let everybody know on the call, thank you for taking time to learn with us today. Hope that you got some value. Feel free to share the recording or other stuff with your counterparts. And if you'd like us to speak and provide CE credit to your firm or study group, just reach out. As you may know, we have an array of different programs. We'll be doing our Disability Insights on May 16th, and we'll take off presentation-wise through the summer. And we're going to be debuting a brand new program in late fall, but we'll have 3 more programs for the fall thing. And if you're on our email list, we'll be including you on that where you can sign up. And so with that, I'm going to go and look at whatever questions we might have here. So give me a second. I'm going to read this verbatim, this question, but I'll answer it as well. So please touch on moral hazard in the LTCi industry. Did you collect commissions for policy sold 10 years ago? Absolutely. I don't work for free. And then few would have purchased if they had known what the premium increases were. How does this affect credibility? Um, you're obviously geared towards traditional long-term care. And I don't argue with your thought process. If we, I'm even disappointed in a carrier that I thought would have less claims, and I want to stay agnostic to carrier names here, but a big, well-rated insurance company, I preferred using them for traditional, and they have even let me down about it. So uh, there might be some trail commissions on traditional insurance to answer your question. Usually hybrids or life with rider. Hybrids more so are single premium, or their commissions are paid as you pay the premium, and if there's no premiums due, then there's no more commissions. Life with rider, the bulk of comp comes year one, and there might be a little trail if we have residual premiums being paid. But I am, to your point here, I am in concert with you that, in fact, I have a few friends. I still work with licensed advisors as well as the fee-only community, and I have a few of them that consider it, a travesty if you sell traditional long-term care to your clients because of the past and the untrustworthiness. But I'm on staff at a brokerage shop. We only have two traditional carriers left. One of them does have a 1 or a 10 pay guaranteed premium, though, to stick up. But rightly so, it's a concern, irrespective of commissions. I don't think that way. I think in terms of helping people, providing peace of mind, providing safety nets, and commissions is the vibrant thing. There's not a viable commission-free insurance out there in any of the four, well, annuities, there might be some viable commission-free products that I'm aware of, but with life, long-term care, and disability, there's not a vibrant market to shop from. So whether or not you like commissions, it's the reality that that's where I work in. Um, Give me a second here to read this one. So if you could address what solutions might be best for a single child-free client, that would be much appreciated. Good. I addressed this on one of the slides where I said, don't blanketly stereotype your long-term care thing with every client you meet, because some will need it more than others. But I'm here to get your client and you whatever it is they want, an apple, an orange, or a banana. And when I think of the three flavors, the one that I would rule out immediately would be life with rider, right? Because there's no legacy or need to leave the death benefit behind if I'm single without heirs. So I'd be down between traditional and hybrids. And if our numbers were like what I showed today, the hybrid would be the clear winner. So I hope that helps. And yeah, so the same person asking about the New York state plans. I addressed that a little bit. I don't keep current with proposed stuff. I'm a real quick learner when it actually happens. And again, the last of my checking is that they have two bad things going on in New York that is not going to be good. And one is that they retroact the decision to January 1 if they do pass the law of invoking a payroll tax and creating some kind of universal long-term care program and so forth. They are also only allowing traditional, and traditional is the one that most people don't like the most, if you will, out of the three options. So if I have, and we actually, we don't have this done, but we actually have a separate price grid for New York products because they're a lot fewer and they're not as good as products in other states. So give me a second. This one I don't know the answer to. Is New York State or California working with the insurance industry on development of their programs? This was a major oversight here in Washington. I don't think they are. I don't, I don't know what they would reach out. They're in fact, as I just mentioned with New York, they're trying to make sure that we don't have a rush on product once they announced the law, like Washington did, and they overwhelmed underwriting and all that. And so I don't think they're working in conjunction. I think they're just finding another way to tax, and they're helping the people with less assets and so forth. They're the ones who need these payroll things more. So again, the many are going to pay for the few that can't pay themselves, perhaps is a way to look at it. But that Washington, I think it's disgusting, $36,000. From an insurance guy's perspective, if I may, the fact that Washington has now this state thing, when you talk to a client, they're going to say, it's okay, I'm protected, I've got the state plan. Well, yeah, 36,000, that might get you through a couple of months of care. So they actually, to me, counter and destroy the ability to talk to clients because they'll have an easy out that they don't know enough of the detail to. So there are handouts for this question. We're going to have the link to that portal. We'll have a few of the resources. And again, there's more sources on the portal. One of the links will be a replay of today, which we are recording, including the Q&A here. So anyway, let me digest this question here. This is a little bit of a long one here. I'm not sure how to, I'm not sure of your question here. Reacting to the first question, so talking about the long-term care and getting compensation, whatever, one colleague pointed out that even with a doubling of premium, our client's cumulative premium over 15 plus years was comparable to a few months benefit if he went on claim. And this was a Genworth policy. So a couple of things, and maybe I do understand you here. There's no way, well, let me do this. Under my website, if you go to if you look up our, and in fact, I just reiterated this in a newsletter or two ago. But if you go back, if you look at our newsletters on our website, the very first newsletter we did when we revamped the new website, it was like June of 23, I think it was. But the very first one has a lot of stuff about Genworth, so you can read more there. But it is true, and I'm working with a couple of clients right now. I get a lot of inbound calls to discuss what to do with my Genworth policy and all that. And the reality is, I can't price, even with these substantial increases, and some people have had 100% or more. Even with these increases, if I were to build the same bucket of protection and products today, my premium would be substantially higher than where they are. So there's some integrity, if you will, there's some value of having it longer and paying in versus where you'd start today. But I'm concerned of Genworth, since you mentioned it here. I'm concerned of their long-term proposition. They might go the way of Penn Treaty. And again, you can look in our newsletters, and if you go back to the very first one, I have that. And I know I did a retread in the last few months, and apologize, I don't know which one that is. So I think I've answered all. We're at 11:59. If you came in late, I'm staying on for another minute, so you can log your 50 minutes. If you can't answer your survey today, tomorrow in 24 hours, you'll get the same survey. So if you've answered today, ignore tomorrow. If you can't take time to answer after the call, please answer tomorrow. Most importantly, put your CFP code in there or tell us if you're not one so we don't have to chase you down. And thank you again. Perhaps we'll see you on our April 16th CE program on disability insights. And I'm here for another minute if any other questions pop up. All righty, everybody. Thank you. You have a wonderful day and appreciate your time.